So let's get technical. What are the technical indicators showing you as we enter this last week of trading?
Well, the last couple of days have actually been pretty encouraging. We've seen S&P rise back to near former highs. I think we have some work to do with regards to QQQ and really the broader indices. When you look at the Russell 3000 or the value line, those have not shown the same degree of rally off the lows. And that's something that I still think we need to see before we can have real conviction that we're going to have a huge surge into year end. And so I'm certainly watching. I think there's reasons to be obviously optimistic. Everybody's had a difficult couple of years, and we've seen this massive sector rotation and social unrest. And now I think, this is a time when everybody expects the market should be going up, and it has been the last couple of days. And so let's see if we can really follow through here. But, I do have issues with the degree that yields are not really following through. And we have seen a lot of defensive sector rotation in the last month. I mean, the only sectors that have really worked on a one-month basis have been the utilities, REITs, staples, healthcare, and yes, technology, to its credit, has also shown pretty good strength, but to a lesser extent.
All right, Josh, I believe you have a question.
Hey, Mark, do you think that yields are as meaningful of a confirmation for an equity rally as maybe they had been in prior generations, just given the absolute ocean of cash that exists out there and how starved everyone is for yields? Should we really be thinking about what a 10-year is yielding, for example, as some sort of forward-looking consensus of the crowd about GDP growth? Or is it really just a liquidity story and not that important anymore?
Yeah, great question, Josh. I don't necessarily look at the absolute level of yields as being a concern. It's more when you see evidence of yields that are starting to roll over. And we saw that back in the middle part of November after the Powell pivot, and we saw yields really fall apart, and equities responded and also pulled back pretty sharply. So, I would just like to see some evidence of 30-year yields and also 10-year really starting to show more strength. That would certainly help the financials. Right now, if anything, we've seen the opposite. We've seen stocks like JP Morgan and Goldman Sachs are down, 5 to 6% over the last month, and a lot of that has been because of yield curve flattening out and also yields pulling back. And so that's certainly an issue that at least affects sectors like financials that I'm watching.
John, over to you.
Well, I guess I'd be somewhat curious. I know your group over with Tom Lee and so forth at Fundstrat, you guys have tracked pretty closely travel in particular, but you take inputs from all kinds of things. Obviously, you're here because of the technical expertise, but are you seeing travel, the demand for travel picking up? And if so, then that's going to mean that a lot of the travel-related stocks, not just the booking stocks like Booking.com and Priceline-type businesses, but a lot of the airlines. Do you see those as being a sector that investors should be watching in early 2022?
Yeah, John, I think, look, you're getting towards the end of the year, it's always important to look for signs of mean reversion. And we've started to see that a little bit in sectors like biotechnology, for example, that have been hard hit. Other areas that were very strong, like automobiles, have now recently started to lag. So we're always at a time of the year when it's important to do some bottom fishing. I think that's important. But travel in particular, I still think it's a little dicey, at least technically speaking, on how I see it. It's been tough to really buy dips in things like airlines, and we have seen a little bit of evidence of stabilization, but you really have to be selective in that regard.